If you are a high earner or aspiring to be a high earner, then this episode is for you, because we have got a tax expert specifically in international taxation and who advises mainly high net worth and ultra high net worth individuals. So let's welcome our guest, Mr. Shashi Pathak. Shashi, welcome to the Offshore Accountant podcast.
Yeah. Thank you, Sushil.
Shashi is a chartered tax advisor from Chartered Institute of Taxation in London. He is also the fellow member of Association of Chartered Certified Accountants, or ACCA. He has been advising high net worth individuals and ultra high net worth individuals for more than a decade, and his interest lies in international taxations, transfer pricing, and he also loves to teach students, professionals on all aspects of taxations, especially international taxations. And he's been advising not just from London, but also from all over the world, sometimes remotely, sometimes physically. So wherever he is always advising or teaching on international tax matters. Country of focus mainly being UK, but also other jurisdictions as well, like US, Dubai, Nepal, and all other jurisdictions where the international tax principles apply. And he's also a recent alumnus of Harvard School, where he attended a executive education on global tax policies and administration. So let's welcome him again. And I think we should start by actually understanding what high net worth individual would actually mean. Can we maybe define a high net worth individual?
Thank you, Sushil. This terminology, high net worth, is more of a common in our practice.
Yeah.
There isn't real standard definition or benchmarking as such, Sushil. It's more of a we use in our everyday life when we are working, when we're advising people. I generally call that as rich,
right,
and ultra rich or ridiculously rich.
Yeah.
That's what I meant, the ultra high net worth individual. But let me give you one maybe simple example just to illustrate what it may mean. Mm-hmm. In the UK, we have the Financial Conduct Authority, and they have one definition. This is for a very particular purpose, especially for the bank, and primarily those banks who are offering mortgage lending. And some clients they define them as high net worth mortgage customer. And for that particular purpose, they use one benchmarking, I should say, but this is not a standard benchmarking as such for the purpose of defining high net worth. So they use something like this: the income of 300,000 or over a year in pound terms, or the net assets of 3 million or over. So anyone, one of those two criteria meeting, maybe last year or a year or two, they have been treated as, or they would be treated as high net worth, but for the purpose of particularly mortgage lending. So you can tell it is relatively high earner or with the good assets, good net assets they have. I can give you a number of other examples that I have dealt with myself very recently and going back a number of years. I can tell one case I recently did, actually last week. He has the income of about 2.6 million pound. I can definitely tell he is ridiculously rich, therefore ultra high net worth individual. There are other clients in the region of about $250,000 income up to $1 million. I normally tell them or the brand them as high net worth. But
right,
it is nothing standard. It's just something we use in our everyday, day in, day out work. So in summary, rich and ultra rich.
right.
Definition, but no specific as such.
Right, just a pointer where you do understand, or giving just a simple benchmark, like you said, or a simple band where if you are earning upwards of 300,000 pounds, then you might be called a high net worth individual, or in case of wealth, if you have assets of 3 million pounds, then you might be called high net worth individual. But that is country specific, also specific to a certain area where mortgage lending is happening, but people might be living in some other jurisdictions where comparison might be a bit different.
I'm sure it will be different, because that was just an example I wanted to offer you, because that I was aware of, and that criteria was set up by the Financial Conduct Authority in the UK purely for that particular purpose, and they use a term called high net worth mortgage customer.
Right.
But it's not necessarily applicable per other areas, including the tax.
Right.
But generally, I would say anyone earning the above average income.
Yeah.
Basically, again, what is average? Nobody knows.
Right.
Thank you.
Right. So whatever is average in a certain jurisdiction, a certain country, and if someone is earning a little bit more or a bit too much than the average, then they might be called as high net worth individuals.
I think it's the everyday word,
Yeah.
everyday term that we use when you are working in office, and we kind of understand, the tax nerd people understand what that meant generally.
Right.
But it's nothing standard, as I mentioned.
Right. So someone who is earning good amount of money, we could call him or her high net worth individual.
Yeah.
Just a rough idea, or for just a rough idea of someone who might be earning a bit more than the rest of us, right? So maybe we could take an example of an employee who is working in Google, right? Okay. A software engineer of some sorts. We might call her a high earner. In millennials, and also someone of our age, between 20 to 30 years of age and earning quite a good amount of money, what they focus on is how to earn money, whether or not they are earning money. But they tend to not understand the tax implications of money. And if someone is earning good, right, if they are not too careful, the tax man may come and take all the money from them.
A big part of it.
Yeah. A big part of it. So today's session is how to think about taxation while your earning is rising. It is better than most. Let's take the example of a Google employee. If she's earning a certain amount of money every month, what are the taxation or tax matters that are attracted to her income, and what are the things that when she's thinking about what the government is owed from her income?
Thank you. You picked up Google. I had been advising a few employees who were working in Google in the past, so I can pick probably an example from there. But in no way I would want to put a disclaimer here that I'm neither offering any tax advice nor any tax planning hints as such, but it's going to be a general conversation around the tax matter more in the global context than any particular tax jurisdiction as such. Picking up that example, I was advising a beautiful woman from Canada. She did come to UK at some point a few years back, and she was working full-time in Google with good 6-figure plus salary. And she came to me, not me personally, don't get it wrong, to my firm, but because I was advising more cross-border clients, so the case was assigned to me in London. And I looked into her case. I found she was having good salary, but also some good benefits. And she wasn't aware that those benefits were also subject to tax, which actually needed to be paid out of her pocket. Plus, one more thing, I found out that she was offered some share schemes. And she wasn't too sure which one she should go for. So in that case, I particularly picked up, reviewed a bit, and advised her to go for a certain share scheme and not the others. For example, probably in many countries around the world, I should imagine that they would have some tax incentive around the share scheme. And some share scheme would offer some tax breaks, and others could be treated as same as gas salary. And therefore, those are the areas you can look into as an employee to begin with, whether there are share scheme or the other perk or the benefit schemes that could be more tax benefit in terms. That one. Two, there may be cases, again, around many countries, I would assume that some benefits may be tax-free and the other benefits may be taxable. Another one is there may be other schemes like pension contribution, like insurance purchase and contribution to some other schemes, maybe annuities, etc. And those may offer you some tax reliefs. And they are pretty standard. These are not any aggressive tax plannings. They're pretty standards which anyone could do. Even by a quickie research around, you would be able to decide about that. You won't even probably need to go to the tax advisor. But generally, not I'm being a tax advisor, I would always advise that it would be wise to spend some time and maybe a small fee and speak to the tax advisor rather than things get wrong afterwards. So there are always the opportunities to do some basic tax planning and tax managing. And that's perfectly possible and that's perfectly acceptable.
Right.
Thank you.
So tax planning is also a part of financial planning as well, right? Where in this example of one of your clients, where she was not aware of taxation on her benefits, so due to that, some other people, or in this case, she might have, if she had not planned correctly, then the salary that she actually got, other than the benefits, she might have use it for some other purposes without taking in account the benefit tax that she might need to pay to the government, right? So if she understood that the benefits, even if it is not cash coming into her purse, but it's still a part of salary and allowance, right? So she need to pay taxes on that amount, and if she understands that, then she would be quite wise to put aside some amount for tax purposes, and when it is time for filing returns or filing or paying the taxes, then she will be able to pay the government. Otherwise, she would have bought something fancy for herself or used in some other purposes as well.
No, that's right. We do have a number of clients like that who actually wouldn't understand finance. Obviously, not everybody would understand finance. Everybody is good at their work, what they're meant to be doing. So everybody would have their own core competencies. But some knowledge of financial literacy, financial skills would always be useful. And it goes without saying, as you said earlier, the tax literacy is, of course, the part of finance literacy. And someone who is employee, probably bulk of the tax would have been deducted at source. Therefore, it may not matter so much in terms of coming to pay the tax at the year end. But where there are other benefits which wasn't taxed at source, for example, including the share scheme and other taxable benefits, yes, in that case, someone would have finished the money in the bank account by spending, not necessarily knowing that there is tax to pay at the year end, and they might even need to borrow money to pay the tax. We do have cases like that, and therefore, in cases like that, we try and do their tax return well before the deadline so that we can advise them the actual tax liability where they needed to pay. But it depends on whether they are within the regime of tax being deducted at source or tax paying at the year end.
All right. So what I want to do is I want to draw an arc for that Google employee, right? Where now she's an employee and she might think about leaving the job and going out on her own or establishing businesses later on. So let's draw an arc and what taxes would be attracted on her each step, from being an employee to going out on her own as a freelancer, and then adding some employees and then setting up other businesses, right? So let's say this Google employee left her employment with Google.
Okay.
And she started out as a freelancer, and she's providing services to other firms and getting paid. Now she's not an employee, she's working on her own. What is her tax position? What changes has occurred there, and what should she think about when she's collecting money, and also what she owes to the government?
Thank you. Let's go back one step.
Sure.
Employee, whether employee or self-employed, freelancer, the tax is what we call is income tax or the personal income tax. Depending on the jurisdiction, they may have slightly different name. For example, probably in India and Nepal, they call income tax. In UK, they call personal tax, but it is tax. That's first. Second, depending on the nature of the income, there may be one layer of tax that's called social security. I think in Nepal, they do have social security. In UK, they have something called national insurance. Nothing to do with the word national and nothing to do with the word insurance, by the way. It's another type of tax. So that's another thing. And depending, and not very countries would have that, by the way. But UK has a very expensive national insurance tax rate up to a certain limit. Therefore, employee would have generally higher tax rate in total, effectively. And also, in UK, I have to add one more thing, just as an example, that employer would also need to pay extra tax, something called employer's national insurance, per any amount, any pound paid to the employee. Therefore, there is one more layer of tax. Not necessarily that's applicable in many other countries, but that's one typical example that I can offer. Now moving on to self-employed, freelancer, the same beautiful Canadian girl now moved to not as an employee, but as a self-employed freelancer. So the first thing, let's clarify, the freelance is a business. And sometimes we call that one-man band, one-man business we call. And that man means woman as well. Please don't get it wrong.
Yeah.
So now instead of she's getting paid monthly, she may get paid differently, more periodically, or on a work basis, or on a time basis, or any other arrangement, including the project basis, etc. So she would get now gross income in her bank account, which hasn't been tax deducted at source.
Yeah.
So the first thing is she needs to inform that to the respective country's tax authorities where she has been residing, number one. So she needs to tell the tax office that I am now doing a business, I am now self-employed, I am now a freelancer, so I need to pay tax myself, for example.
Yeah.
So here is the case. Now she needs to keep some money aside for the tax for sure, because she would have received the money in gross. Here, the record keeping is more important than the employee.
Yeah.
Because here now she needs to calculate her income, the gross income, the expenses, the net income, the tax, and obviously the amount of tax that she needs to pay.
Right.
Therefore, record keeping matters more here than when she was an employee.
Yeah.
Come self-employment, come business, she would be allowed to deduct some relevant business expenses. What we call is wholly and exclusively spent on the business related expenses. So those expenses she is allowed to deduct. Here she can check what can be allowable and what can not be allowable, for example. And when she was using, for example, her computer, her other equipment, her maybe home is part of the office, then those are the expenses she can deduct from the money she's making. And whatever comes in the end, what we call is the bottom line. We're accounted, we know that, and she will actually calculate the tax on it and pay.
Right. So let me break it down. So when she was an employee, she didn't have to think too much about taxes. Though taxes were attracted, the company that she was working for would deduct the tax before crediting the amount to her bank and depositing directly to the government.
Correct.
But now when she is going on her own as a freelancer, as someone self-employed, now she'll have to keep track of how much she's earning. She will earn most of the revenue, right? So when she was an employee, her gross income was, let's say 100, she received 50, right? 50 was deposited directly to tax. But now as a self-employed, she would receive most of the 100. Now she will have to calculate what her actual final income is and then pay taxes to the government. Now she is liable to keep the records of what are her receipts, what are her expenses on the business side of things, and then she will have to see what tax rate applies and what payments she might need to make.
Correct. Going back, generally in some of the countries, if you're employee, the record keeping is for 3 years. If you're self-employed, mean the business, the record keeping goes for 6 years. A simple differences. Now, what happens is the responsibility of reporting, what we call is compliance, lies back to you. That beautiful Canadian girl, because she has now not been paying tax at source. Therefore, under the self-assessment principle, many countries have this system now. UK did introduce this back in, I think, 1996 around. And I have to bring this as an example that one of the really effective self-assessment system I can see around the world is, of course, UK. They are really doing well on that, and a lot of online system has been developed and is working very well. Now here, it is your responsibility, it's the taxpayer's responsibility to tell the revenue that here is my income, here is my expense, here is my net profit, and here is my tax, and here is the check. So here, whole thing goes around the self-assessment. Although there are some other restriction or some other provision to this, but primarily it is the self-assessment. Therefore, under the self-assessment, the onus is on you as a taxpayer. So you need to be keeping all those records correctly, appropriately, and for appropriate period of time. And if there is any question subsequently after submission of the tax return from the revenue, that you should be able to reply to them without too much of the hard work. I mean, without just going through and finding the information, but having it readily retrievable in your file records.
Right. I find both advantage and disadvantage of someone going as a freelancer, right? Where if you were an employee, you didn't get the part where you could deduct your expenses from the income, and that only pay for the profits. But now as a freelancer, you can actually deduct all the expenses that you put in while earning the income, and then only pay for the profits. But as a disadvantage, I would say, you would have to keep records, you would have to file yourself, you'll have to pay taxes yourself, and there's quite a lot of administrative work that you need to do in terms of just complying with the tax man.
Let me rephrase it.
Sure.
If you allow me. That's called employed versus self-employed. That's where you are now. Right. Under the employment, the expenses that you can deduct from your income are very limited. What we call is wholly, exclusively, and necessarily for the purpose of performing your duties. Only those expenses you can deduct. Under self-employment, the term necessarily aren't normally there. So wholly and exclusively. Still, it has to be wholly and exclusively incurred for the purpose of the business, but less stringent than obviously when you are an employee. This is just an example I'm drawing from one of the tax jurisdictions that I have been working and advising. But of course, there are differences. And if you think about a business, you can do a lot more than as an employee, generally. We all know that. You have the more freedom, plus you have the more opportunity, depending on the amount of work you're going to get, of course. So it has all good and bad, but I would always say, as a business person, having the business acumen at the back of head, that it goes without saying, people would normally tend to and attempt to go for the business at some point. But it depends on individual to individual. And there is tax matter as well to be considered. And one of the factor, to be honest, is a tax when people are moving from employed to self-employed. But it has to be a genuine self-employment, not just the self-employment on the paper. I just want to warn on this particular point.
Right. Now let's say the Google employee that went into freelancing, she's doing great, right? So she is expanding her business. Now she wants to bring in some help in terms of employees, in terms of adding team members, or maybe some other people that can help with her business. So now what is her tax position?
I know what you're saying here. First, let's clarify, we are not promoting Google as such, and we don't get commission for bringing this example.
So you may be YouTube employee or some other else as well.
It just happened to be that example. You're talking about now owner-managed business. You're expanding business, you're doing on your own. Now the business went well, therefore you want more people to help with. So you want to set up a more proper business and the team. Here, it's a couple of alternatives. You used to be one-man band. Now you're maybe 2, 3, 4, 5-man band, for example. Or you have now more work, therefore you need more resources. For example, the admin person, for example, the technical person, for example, maybe even a business partner, and so on. So one thing is, you as as a self-employed, as a sole trader, you can hire employees. Or rather than hiring as an employee, you can bring them as a partner. For example, you may be able to set up a partnership, and the partnership would have various different entities. For example, what I call is a classical partnership, traditional partnership, 2 or more people coming together and working together for a common interest. Or same thing, but under slightly different legal structure. For example, LLP, limited liability partnership. For example, LP, limited partnership. These different type of partnerships would have slightly different tax and the reporting implications, for example. Partnership means, simply think about it, more than one sole trader together. Generally, in many countries around the world, many tax jurisdictions, what happens is, when you set up a partnership, whatever the total profit comes up, you split according to your agreement, and whatever the profit share you have, you pay personal tax on that share of the profit that you have made from there. And your partner, your business partner, won't be responsible for paying tax per your share of the profit. So from that point, it will be equivalent to, like we discussed earlier, the freelancer, the sole trader. But in some other countries, partnership itself has to pay tax on the profit at X percentage. I heard Nepal has that arrangement. That partnership itself has to pay 25% income tax on the overall total profit the partnership made. So this is slightly different case. Now, going back to the point that you mentioned, there is another alternative. Rather than going to the sole trader and having employee, or bringing those potential employee or the potential people that you want to work with, you want to develop a team and bring them as a partnership, you might want to set up a limited company, for example. Again, the limited company would have different structure. Let's talk something very simple, the private limited companies. And those who you want to invite could be shareholder, maybe with a different proportion, could be director as well, or could simply be employees to begin with. And maybe you can offer some conditional shares in future. Again, something we talked earlier, here the share scheme can be useful. But now the tweak is slightly different. If you're setting up a company, now it's a separate legal entity. Therefore, the company itself is liable to pay tax on the profit the company makes. And in many countries, it's called again income tax. In some countries, it's called corporation tax. And depending on the countries, different countries would have obviously the different corporation tax rate. For example, in Nepal, I think generally it's 25%, subject to some restriction or some other additional rate, higher rate for some of the industries. In India, around that. In UK, it's as low as 19% and as high as 25% from this year. Dubai used to be nil tax rate, but it started 9% from last year. And for the ridiculously large companies with the global combined turnover of 750 million euro or above, so the minimum domestic tax is going to be 15% coming from next year, for example. This is actually in line with the OECD's BEPS Pillar 2 global minimum tax of 15% guidance. So you can tell, depending on the country, and the Ireland, obviously, I have to mention that just 12.5% generally the corporation tax rate. So depending on the country, the corporation tax rate is different, of course. And now what happens after tax profit that you made in the company? Because you now are shareholder or director of the companies. So the money that you were making and you are billing through the company is now company's money. And the company paid tax, say 25%. So the post-tax profit is something now you want to extract out for your personal living, of course, because you used to get profit yourself, you used to get a salary before. You don't have any of those. Now you need to extract is either salary or dividend or the combination or some other. Now here, again, the potential tax planning come into play. This is where we also consider different aspects of the tax planning. Again, the very standard tax planning, because generally around the world, the way the salary get taxed, the way interest get taxed, the way rental get taxed, the way dividend gets taxed are different. Therefore, here now we talk about the what we call is profit extraction tax planning. So those who are working for the company as director shareholder, how they would be remunerated. And where there is a dividend would also be subject to a potential withholding tax. Again, the rate and whether it is subject to withholding or not is depending on the countries and their domestic.
So a lot of things to unpack there. So someone who is a freelancer now expanding a business could still be a freelancer or sole trader, get in employees and the expenses that they put in as salary for the business that they could use as expenses and deduct from their income, and they could file as a sole trader, right? Self-employed person. But they might want to, if they are planning for a long-term business where they are not the business, but a business is a separate entity from themselves, they might want to start or set up a limited company, right? And if they set up a limited company, then the limited company and the person would be two different separate entities or persons in the eyes of the law. And so those two people, the person and the company have different tax obligations, right?
Correct.
But as a shareholder or as a director of the company, you should be able to understand what the company is liable to pay and also what you are liable to pay when you get out some profits from the company for yourself, right? And there are separate rates of taxes for the company. There are separate rates of taxes for the person. Whatever the person was earning first was her income. She was being taxed wholly for the business as well. When she has opened a limited company, only those profits, though the corporation might have earned a lot more, they will pay something on that and there will be something remaining. But of the remaining, if you want to get only some portion of that amount, then you have to pay only for that portion of the profits that you take out from the limited company.
Yeah. Let me take you back to one step. First, think about a business. It is a business, whether you run that business under sole trader, partnership, or limited company.
Yeah.
These are the different, what we call is mode of business,
Yeah.
vehicle of the business. But what you are still doing is the business.
Yeah.
That's the first thing. Therefore, the standard rules about the businesses, for example, recording income, allowable expenses, etc., are similar.
Yeah.
Come taxes, individual partnership would have one way for the things to be taxed, and the company would have different. It's not the tax rate, it's the tax regime altogether that's different. Therefore, except a few countries, sole trader and partnership would normally get taxed in one way, and the limited company would get taxed in different way. Coming out of what you're saying is, within the company, if you don't need money, you can leave it there.
Yeah.
That's called reserves. We are accountants, so we understand that. So reserve simply mean, let's say, accumulated profit after tax in the company. And out of the positive reserve, if you need, if you want to, you extract as dividend. Now, that dividend would be liable to tax in the hands of the recipient, those shareholders. And depending on the country, again, the tax jurisdiction, there would be different tax rate. And also, again, depending on the regime, in many countries, the tax on dividend would be withheld. That's one area. So the tax withheld is a mechanism. Still, it is the income tax.
Right.
Now, what you are saying is, in terms of a business, in terms of an expansion, you want to consider which medium of or which mode of the business is going to be suitable is down to you. Whether you can carry on working and running a business as a sole trader, you can still employ people under your sole trader, or you want to bring them as a partner, or now you want to run as a company. And when you're running as a company, whether you want to run as yourself, like a sole trader, again, there you are being 100% sole shareholder as well as a sole director, or you want to bring some other as a shareholder there. And there again, the tax planning may come into play. Maybe some of your family member is helping you. There you can bring them as a shareholder with X percentage holding. Maybe you want to bring them as employee, and up to certain amount, there is a tax band. We know that up to X amount, it is tax-free salary. For example, I think in Nepal, it is 500,000 rupees.
Yeah, 500 for single.
Yeah, in UK, it's about 12,570 pound. So that's a tax-free limit generally. Therefore, those who are working for you within your family, from your family, it's a very simple example, and it's a very simple tax planning, that they may get up to certain small salary, obviously compensating their services, no doubt. Then on one side, that can be deducted as expense for the company or the partnership or even the sole trader. And on the other side, they get that salary, if they are not earning elsewhere, then almost tax-free.
Right.
It's just a simple tax planning, as long as they are helping you, they are working for you. Or if you are hiring someone from outside, then you probably need to pay either salary or bring them as a partner, then share the profit, or bring them as a shareholder, then share the dividend. So that could be depending on your structure, depending on your plan, and depending on your, obviously, the business model.
Right. And also, I wanted to add something here. We are not talking about when you are doing business, there are all sort of taxes that are attracted. There are sales taxes, there are VATs, there are excise, there are customs, but we are focused more mainly on income tax.
Direct taxes.
Direct taxes. So that is what we are talking about. Now, let's say the business is booming. It has never been better, right? The person wants to expand, and they have expanded in their country. Now they want to move beyond the border. Now they want to expand their business to a different jurisdiction altogether, add a different branch or different company, the same business to a different location in a different country. Now, what should we think about?
Now it's getting more fascinating here, and this is one of my, of course, the very interesting area. There are many factors. Tax is relatively complex.
Yeah.
We all know. Tax about a jurisdiction complex itself. Now thinking about more than one country, one jurisdiction, even more complex.
Mm-hmm.
Here now you're thinking at least three things. One, a country where you may have been running your business earlier.
Mm-hmm.
And two, where you are expanding your business to, what normally I call is the secondary jurisdiction. And the three, what I call is the cross-border position.
Mm-hmm.
So there are three things at least you should be considering. It goes without saying which tax jurisdiction, which country you are moving to or you are expanding to. That's one thing. So you need to be considering their compliance position, their tax position, their other all sorts of potential compliance and the relevant matters, not just tax.
Right.
And the other thing is what I call is host country, home country. Just try and understand this. Normally home country means where you are residing or where your business originally was or is. And the host means, say, the second country where you are expanding your business to. Now, here's the thing. In a number of jurisdictions, for the first few years, you may get tax break. You never know. Or you may get lower tax rate. For example, Singapore does offer that.
Yeah.
And there are other things as well. In a number of countries, in a number of jurisdictions, they may have a separate enterprise zone where if you set up your business there, you get 0% tax rate. In Dubai itself, again, we're coming back here, they have that 0% zone there, tax-free zone there, even now. Even with the introduction of corporation tax at 9% and 15% for the very large companies, they still have this tax-free zone. So if you're moving into that. But what is the restriction there? That's the other thing that you need to find out. And what other things that you need to be considering in addition to the tax? For example, the availability of maybe the potential resources in terms of EHR, in terms of other excess, and so on. Here, I think jumping onto the tax, you're thinking of tax of more than one country, number one. And two is how the reparation of the profit gonna work in terms of tax. Say you set up a company or expand a business from, for example, Nepal to Dubai. Now you're paying, or your company is paying tax at 9% in Dubai. So the rest of the profit is there. So how you are going to extract that profit and bring back or remit back to Nepal where you are residing, for example. And are you the only shareholder of the company or not? Are you setting up that as a joint venture? Are you setting up that as a subsidiary? Or are you setting up with a local partner, for example? So it depends on the jurisdiction. You might need to choose one of those. In some countries, maybe even Nepal, including, not necessarily every foreigners could just come or go and set up the business on their own. You might need a local partner there. So that's another area that you might want to consider in addition to the tax. Many European countries, many developed countries won't need that. You can, for example, just go and set up a company there and begin running a business. You don't necessarily need a local partner, for example. You can be from anywhere in the world, you can be shareholder director. That's the area. Come tax again. Now, it's what I call is the combination of more than one country's tax. And as an individual or as a company. When you are setting up a company or incorporating a company in another jurisdiction, generally in most of the countries where the company is registered, incorporated, would be subject to tax of that particular jurisdiction. That's one area.
Right.
Therefore, whatever corporation tax rules are there, you follow that, you pay the tax there when you make the profit, right? And now, after profit figure, the reserves that we talked earlier, how that reserve can be redistributed to the shareholders who may be residing in another country. In that case, now the dividend rules come into play. Also, the dividend tax mechanism would come into play. For example, the withholding tax. The many countries would operate the withholding tax regime. There are a few countries I know, they don't operate withholding tax altogether, but many countries, they do. Therefore, depending on that rule, some of the dividend that you are wanting to redistribute and bring back to where you are residing as a shareholder, there you might need to be facing the withholding tax. Now here comes the countries where you are living and where you are receiving your dividend. What is the dividend tax rate there? That may matter as well. For example, if you are setting up a company in India and India may have 10% withholding tax on dividend when the company is paying out the dividend, and say you are in Nepal and you are receiving dividend in Nepal, and Nepal has 5% tax rate on the dividend. Therefore, you have already paid 10% there, here you meant to only pay 5%.
Yeah.
Now, otherwise it would be 5%, but in total here it's going to be 10% tax on your dividend. Although you get relief, you're only going to get relief up to the tax you're paying in Nepal, for example. I'm talking about very general principle here. I'm obviously no way expert anywhere near about the Income Tax Act 2058 or around. Therefore, it's just to take it as general conversation than anything around the tax advisory or the tax technical. So here it is. Sometime you might want to think about these things before setting up the company than the after, because you may get stuck. So it depends on your own business plan. So tax plan could be and should be, I think, part of the business plan, not just a separate thing. Come individual, I'm just wanting to take you back one step. If the gentleman who was running a freelance business herself, wanting to expand her service individually to another country, then there is another set of potential tax that he or she needs to consider. First thing, whether the money he or she is making in another country is going to be taxable in that country or not. So that's another area that's needed to be looked at. Plus, if taxed there, then how that tax would be relieved in the country where he or she has been residing and paying the tax. And in the first place, whether the source country, another country, would have right to tax on that income or not. That's the other area. So I'm sorry, I'm probably making it a bit more complicated, but come international is far more complicated than what you and I normally would think.
So a lot of things to unpack, and first we are talking about a corporation that are expanding into a different jurisdiction, and when you are thinking about moving your business, not moving but expanding to a different jurisdiction, what you should think about is you make a business plan, what revenue you will derive from there, operations that you are going to do. But tax plan should be one of the areas where you put in your business plan. So in your business plan, you should also be thinking about the tax jurisdiction or tax attracted by that jurisdiction, because you might earn a certain amount of money, but if the taxation is so complicated or taxation is so high that you will not be able to bring back that you actually want to, then it is worthless. It would not make business sense. So in that case, you talked about three things you have to understand. You have to understand your own jurisdiction, the place you are residing, the first corporation that is set up, and then the next corporation that is being set up or the expansion that you are doing in a different jurisdiction. So tax of your home jurisdiction, tax of your the foreign jurisdiction, and also the tax the cross-border relationship between the two countries as well, right?
Yeah, the tax relationship.
Yeah. And then we also now talked about, if you are still a freelancer, you have not set up a business, but you want to give your services. Say for example, you are a UX designer, right? Or any sort of architectural designer, and you are residing in UK. Someone from Malaysia wants your help, your architectural design, then you do provide the services. But you have to think about your own jurisdiction, the Malaysian jurisdiction,
Correct.
and how they interplay with each other as well.
Interact, yeah.
So that as well. And now let's say we talked about the freelancers, but we also talked about corporations. Let's say the person has become so big as Elon Musk, right? Where the business is so big in different countries, and it has different businesses interact with each other from different jurisdictions, different countries. Now what should you think about in addition to what we have been thinking about?
Okay, now we're getting bigger, right? When we get bigger, there are more things to consider, of course. The bigger the size, the revenue would have bigger eyes on you. And you expect some sort of audit every year or every alternative year and all that. You need to have your record keeping robust, no doubt. Now you need to have a lot of other things. When you have international businesses, you need to understand different countries' perspective. Obviously, you employ the local tax advisors. You're not expected to understand everything yourself. So you employ the local tax advisors, try and understand the legalities, try and understand the compliance, try and understand the tax mechanism, as well as the potential tax planning, etc. What may be the tax breaks. One of the things, it goes without saying, I want to bring in is this. In every country, there would be some tax breaks available, whether individual, whether company. What we call is tax incentives. For example, one of the common is R&D tax credit, research and development tax credit. So subject to satisfying a number of criteria laid by the respective tax authorities there would be this credit. So this research and development credit is one very important I always want to bring in. Whether it qualifies or not, obviously you need to be checking in the respective countries and with the tax advisors there. That's one area. Second, what are the other things? What other tax and the associated matters that you need to be considering is what other scope of tax plus the compliance. Sometimes the compliance hurdle also needed to be looked at because it may be so complex to try and match it, to try and make it work. So you might want to actually give up depending on the size of the tax benefit you're going to get. And when the company gets bigger, you want to attract talented people. And in order to attract the talented people, you want to offer, like we discussed earlier about the Google girl from Canada, you want to offer some other tax incentive or the tax advantaged package where you may be thinking about the CRS scheme, different CRS schemes with the tax benefits available rather than just the cash salary. Plus, cross-border tax. One of the area I have to touch here is, of course, the transfer pricing. There must be some intercompany businesses, intercompany transactions that may be purchase or sales, that may be goods, that may be services, that may be other intangibles, that may be financial services, maybe financial loans and other guarantees provided by, for example, the parent company in one country and the subsidiary in the other. So how those services, how those transactions would get priced. Especially in all countries around, there is some provision about the transfer pricing after a limit, after a threshold. And therefore, you need to be now having robust documentation again in terms of the service that's being provided intercompany. And intercompany transaction, intercompany pricing are always big thing. Even recently in Nepal, I understand they have introduced the Transfer Pricing Directive 2081, just going back a couple of months in October. And that's going to be applicable for the transaction over and above 100 million rupees. So that means here we used to be probably thinking just pricing, just charging X amount. But now that needed to be up to the mark, means up to what we call is arm's length price. In simple terms, open market price. That's one another area. In fact, a big area when the company gets bigger, of course, there has to be and there would be the intercompany transaction, and those transactions are subject to transfer pricing regime. no matter which country normally you go to.
Right.
And it's a big area. I think we need to put together a separate session for the transfer future, but yes.
Yeah.
And it goes without saying a couple of more points that dividend, when there is a corporate structure among or between more than one countries, then when a company in one country is paying dividend to another company in another country, then again the withholding tax needed to be looked at as well. And other intercompany charges, other intercompany payments, for example, we touched intangibles, the royalty payments, how the withholding tax would work, maybe other management charges, other service payments, how the tax would actually work for those kind of intercompany services, intercompany charges, intercompany payments, especially in around the tax as well as the withholding tax. Sometimes withholding tax really matters, especially for the royalty payments, for the interest payments, and so on. And also, what is the size of the capital and size of the loan? What we call is debt and capital ratio, etc. That would also matters. And generally in profession, we call that is if the company is thinly capitalized, means so much of the intercompany loan and the little share capital, then there may be some other restrictions as well in terms of the allowability of the interest as an expense. So it's quite a lot of things, Sushil, that I don't think I can cover in an hour, but it's a big area to actually carry on talking.
So basically, the bigger you get, the bigger compliances, the more jurisdiction you get into the compliances, the things or taxes, the tax regime, the tax schemes that you have to think about also multiplies quite a lot, right? And also, the more companies you form, giving services to each other, there are transfer pricing regulations that you have to follow
as well.
And that's quite a lot of things to think about in taxes. And you are not someone, a businessman is not supposed or not, we do not want you to understand everything. You'll have advisors, your company will have advisors for themselves, right? And it can be quite confusing for themselves. Our tax advisor also focuses only on one specialization. So there
one
are
jurisdiction at a time at least.
So there are specialists for every jurisdiction. What you want to understand is that there are tax implications for every jurisdiction. There are tax implications if you are interacting business-wise with your own associated companies inside the country and also between different jurisdictions. Then there are tax implications, and you need advisors to advise you and who understand those jurisdictions, those taxes, those regimes, right?
Correct.
Someone watching might be discouraged, right? I do not want to build such a big business. I just want a pretty good life for myself. I'm good as a freelancer. I'm earning quite a lot, maybe $100,000 to north of $1 million annually. So that's where they are quite happy, right? But when you earn money, you also save and you want your money to grow. So there are investments of some sorts in shares or in real estates. Now, if that person doesn't want to do any other business stuff, they want to set up or think about income taxes or finances for themselves, right? And they have investments. Those investments could also be in companies, but for themselves. Now they do not want to think about the corporations. They have CEOs there, they will do everything there. They want to understand about what they should do, what taxes are attracted if they have some certain income that they are generating, but also they have income coming in from investments, and those investments could be in different jurisdictions as well.
Okay, so you're going back to now individual, but not with the active income. What we call is passive income. That normally includes savings, investments, and that may further be broken down into like interest income, dividend income, and say rental income.
Right.
These are again depending on the country and the types of the income, the tax it works is different. Let's take a simple example from Nepal. I think from this year, the tax rate on interest is 6% around, and the tax rate on dividend is 5% around, and the rental is about 10%. So you can tell, a simple example, depending on the type of income, source of income, the tax rate can be different. Now going back again, cross-border, if you are say investing in another country, now you are talking about the source principle versus residence principle. The first general principle globally is that wherever you are residing, you are liable to tax in that country. That's the first general principle. And that applies across almost invariably all or many jurisdictions. Now comes source. It's easy to find source, but not always. Rental income, you can probably easily find where the source is. For example, where the property is. If the property is in India, the source is in India. Therefore, India would have right to tax on the rental income from the property that is situated in India. We call situs principle there. And depending on the double tax treaty between where you are residing and where you have your property is, there would be the double tax relief mechanism. But many countries would also offer unilateral relief on the tax paid in another country on the same source of income. That means whatever tax you have paid, for example, on the rental income in another country, you can bring that and offset against the tax you are paying in your resident country, obviously subject to the limitation and subject to the restriction. That's one. Two, interest and dividends. In many countries, I'm aware that wherever you are residing, the interest income would be taxable in that country only. So, for example, even if you are, say, you are residing in UK and you have your interest income from, say, another European country, then that interest income would only be taxable in the UK, not in the another European country that you have the interest source from. So that's the general principle. The dividend, again, depending on where the dividend is coming from, the maximum withholding tax could be different in rates, somewhere generally between 5% and 15% under the OECD guidance. But these cross-border income, if those countries would have double tax treaty, then you can go and cross-check there what may be the potential tax implication, what are the tax relief, etc. But one thing I would always advise is that there is a potential for double tax relief or the foreign tax credit relief you might want to check. There are a number of cases that I would advise all year around, and this is one of the area that I do. For example, in many countries, the maximum withholding tax on dividend is 15%, which is also the guidance of the OECD. But I have noted that their income, their dividend in another country have been tax withheld more than 15%. And I advise client, look, you can go back and speak to your local advisor there that the withholding tax of more than 15% is not correct, is not applicable based on the double tax treaty between this country and that country. And that's one of the simple, for example, advice.
Right.
So yes, there are a lot of tax implications and a lot of tax potential relief, etc. around available where you have income at individual level from more than one country. But you always need to keep in mind is that the source principle versus residence principle. I know it's a very technically complex area. I don't expect the taxpayer to understand, but I expect the taxpayer to get the right advice with the appointment of a right tax advisor.
Right.
Thank you.
So the place where you are residing also wants to tax your income. The country from where your income arises also wants to tax your income.
Potentially, yes.
So you should understand that there are double tax treaties where if you have paid something in one jurisdiction and if you are residing in another, then you'll get some relief on the taxes you have already paid. And so you should go ahead and understand those treaties and those implications. You talked about principle of taxation on source and also taxation based on residency. And so these tax reliefs would help the individual residing in some place not to get taxed twice. Right.
Yeah, at least if get taxed twice, then at least get relief in one of the jurisdiction. This is, I would say, more for the tax advisor rather than the taxpayers because it's very difficult for them to understand all these. But I think the tax advisor for those should be able to understand and factor these into their advisory.
Right.
That's right. And they are a lot more complicated. Obviously, tax, don't forget, is tax law, and therefore law would have a lot of different dimension. But this is one of the simple discussion. That's right. Yeah.
Right.
And I would always advise if there is double tax treaty, go and check there. Not every country would have double tax treaty. For example, Nepal has only got 11 double tax treaties. UK has more than 120 tax treaties.
Right.
And overall in the world there are around more than 3,000 double tax treaties around. And currently the OECD is working harder on this, even to bring in not just the bilateral, also the multilateral. So this is obviously getting complicated, no doubt, and getting more and more complicated. But just to make the conversation simpler, I would add that if you have more than one source of income, well done, congratulations, that's a great thing to have. But consider tax equally too, from the perspective of the advisory planning, as well as the standard planning, as well as the compliance perspective. And you may or may not realize that there are reliefs available which you may be missing on. And that those legitimate reliefs you might want to grab on and manage your tax and have more money in your pocket.
Right.
Of course, everybody would love that.
And you might want to ask your tax advisor whether there might be some reliefs, and has it been included on the returns, and whether they have been provided there. Now I want to come to the freelancer who has multiple sources of income, and now what he wants to do or what she wants to do is now move around, take a backpack, become a digital nomad where they change residency ever so often. They might want to set up or stay in a different country other than where their citizenship is. And are there things that they should be looking at, or is that a good idea? And what are your thoughts on that?
A lot of thoughts. Good or bad idea, I leave that to probably the individual. I know you talked about the citizenship. Citizenship won't necessarily have the direct tax implication, except America. They have some tax system, some tax principle based on citizenship, but not many countries. So the primary principle is, of course, the residence. So the first general principle is where you are resident for the purpose of tax, there you are liable to tax. Or generally that country would have what I call is home country, would have the primary taxing right on you, generally on your all of the income and gains. That's number one. Number two, where you are making the money from, the source we touched earlier. Then that country may also tax on that particular source of income arising in that country. I call that as host country, or the secondary jurisdiction, or the second jurisdiction. We said briefly earlier, depending on the type or the source of the income, the taxing provision, the taxing mechanism, the taxing principles and the rights can be different. More importantly, if there is a double tax treaty between the home country and the host country, things could be slightly easier, slightly clearer. At least there would be some guidance within the double tax treaty, and you can follow that and you can get things pretty okay in terms of correctness and the compliance. Now, when someone is moving from one country to another, first we need to see where he is residing bulk of the time and where he is making money from. Goes back to the same principle, residence versus source. So he must be paying at least tax somewhere. Therefore, first what we need to try and understand, or what the individual needs to try and understand, is where he is actually residing in, which country. Not necessarily just residing, I mean residing for the purpose of tax. So depending on the country where he or she is in, they would have the principle, the regime of the residency. The standard is 180 days or 183 days. This 183 days is a very magic number. Across many countries, they have this principle. If you have been in that particular country for 183 days or more in a year, then you are treated as tax resident in that country, in that tax year.
Right.
So you'll basically be paying tax there. But this is a very general conversation, as I said. We are not looking into very country-specific discussion here.
Right.
So wherever he or she is, we need to be looking into that country's domestic legislation around the domestic tax legislation around the tax residency, and then planning further from there.
Right.
I think that's the first step. And then where the source is, and goes back to the cross-border again. The cross-border principles and the cross-border provisions.
So why I ask this question is because though we are not talking about a specific jurisdiction, but people have this idea that if you move to Dubai, right, you'll get to keep much of your income because there are no tax, or even if there is, very little tax. So any comments there?
Thank you. I know you come back to Dubai again, and I'd love to. Again, we are not promoting Dubai from any perspective or any sense, but it's just a good example here. We used to think, and we all used to call that, Dubai is a tax-free country. Yes, partly, but no longer the case. It used to be almost no tax in Dubai, but back around, I think, 2018, they introduced 5% VAT. They introduced 9% corporation tax from last year, and they introduced 15% domestic minimum tax for very large companies from next year, in a couple of days' time, actually.
Right.
But still, for the individual, there is no what we call is personal income tax, as far as I'm aware. Again, I'm not the UAE Dubai tax expert, but it's just my general information. And I have some clients from Middle East countries around. So you can tell, yes, there are some countries where there is an income tax rate or the tax rate is low. So you might want to move there. But don't forget, Sushil, tax is not the only factor people would move from one country to another. It's certainly one factor, but not only the factor. I have few clients, they did come from UK to travel around for the first time, and they settle in the UAE. And they've been there. They do have assets back in the UK. Therefore, there are some tax that they need to pay in the UK, but in Dubai, they're perfectly fine and happy. And I did ask them, actually, by the way, what makes you staying in Dubai? And by the way, my colleague name is Sam, and they said to me, Sam, it's a no-brainer. It's a tax. Why so much paying tax in so-and-so jurisdiction? Here is almost a very cheap, low or no tax. So that's the one motivation people would have. But not necessarily everyone would make decision based on the tax rate alone. But I know it is one of the factors. And actually the gentleman answered to me even further, Sam, I could retire 10 years early in Dubai or so-and-so rather than in so-and-so country, for example, UK, etc. So you can tell people would use that as a motivation for themselves to move from one country to another, but I wouldn't just recommend based on that. And even then, who would actually need to follow me based on my recommendation anyway? But yes, tax is a matter, no doubt. Even for the countries, the companies, they would consider tax as one of the important factor when they are considering expanding businesses across from one country to another, for sure. And certainly for the individuals. But that's not the first criteria, probably one of the good main criteria, for sure. Just my thought.
Yeah, for sure, because tax is one of the expenses which takes a large chunk of the revenue as well. So people would look at where tax could be saved, and if changing residency would impact the taxes or the income remaining in their pockets, right? And I think the government of Dubai would be quite happy with us today and maybe feature us somewhere. I hope so. We did not mean this session to be education on or deep dive into what tax percentages or tax
very general
things
conversation, correct,
on different jurisdictions, but what you should be thinking about when you are growing, when your income is growing, when your the number of income sources is growing, and the income is also coming from different countries, and what are tax implications that you should be looking at, because tax compliance is one of the hardest things also sometimes, and also if you do it wrong, then it will come back to
it can be costly.
It can be costly. And also advice, you should also be taking advice from good advisors, because people are selling schemes, tax planning schemes, which turn out to be tax evasion schemes,
avoidance scheme.
The tax avoidance scheme, and you should avoid those avoidance schemes, right? So first, you would not take those schemes at face value, because you have now certain ideas about what taxes are attracted on your income. Now, before we go, I'd also like to ask you, because we have had quite an hour-long conversation. Maybe some things we could summarize into 1, 2, or 3 points where someone is trying to earn a little more, trying to get into that coveted high net worth individual list or ultra high net worth individual list, or they are already on that path. What should they be focused mostly on?
First point, if you are earning, you're paying tax. There's no way out. I'll give you one example. Just a couple of weeks back, I completed a tax work for a gentleman. He was making £2.6 million in just last tax year, and he was paying about 1.2 million tax. So there's no way out. You can't just plan everything. But there may be reasonable areas, reasonable scope that you want to consider. That's one thing. And when you are considering those, consider something commercial rationale as well. What you are doing and not just doing for the purpose of tax. Is there the commercial rationale? Can you justify it? That's another area. And a few other points I would like to add here is that I also touched earlier, there are standard tax planning measures that you want to consider. And there are standard tax advantage regime that you want to consider. There may be standard investment or the tax relief items that you want to take on. For example, the insurance, the annuities, the medical expenses, and so on and so forth. Also, in some countries, they would want to, I have a few examples in different jurisdictions, that they want people to invest in risky businesses, risky startups, so that the businesses would go up as well as they get relief for those investment. So in that case, even if those businesses that they invested went bust, in terms of the loss, there won't be so much of the loss because they get some good tax relief for investing. So there are countries and there are regimes I'm aware of that they encourage people to invest in some risky investment, some risky companies. For example, the new startup, as I said, either through venture capitalists or some other regime. And I know a few terms around this like enterprise investment scheme, etc. So if you are a risk taker, maybe you want to use some of your money to invest there, hoping that the business is going to get better and you're going to get return. But for now, you can get some tax relief. That means the tax that you're going to be paying is going to be lower because you have invested in those particular areas of the businesses, industries, and the investment. So and it goes without saying, get the proper documentation. Keep the good records. It's always the case. And get good advisor before, not after. You want to get it right first, then get it wrong and get it corrected, because it definitely would be costlier than getting it right.
To add to that, I would also say that you do not want any surprises when you are filing your taxes, or as little as possible. So you have to get your advisor first. You have to understand what tax implications or taxes you are going to attract throughout the year, and then plan accordingly. And also planning taxes would also mean when you are going to pay and how you are going to pay is also that comes under the purview of tax planning, so that when at the end of the year you are filing your taxes and you see a large tax bill and you have no money in your bank, then that would be quite costly for you as well. So tax planning, understanding tax should always be done before the start of the year rather than when you are filing the taxes.
I've been saying avoid the last minute. Avoid the Push Masanta in Nepal or 31 January in UK, for example. Do it well before that, so you have time to think around, you have time to put together the information, the records that you already have somewhere collated and kept, bring it into some order, look into it. Is there any potential for tax planning? Is there any potential for the review further, for example? And at least get it done sooner than leaving it to the last minute.
Thank you, Shashi, for your insightful conversation, and I hope that the audience found it useful. And now, when they are thinking about earning money, they will also be thinking about what taxes I might need to pay for the income that I'm earning, and when that taxes need to be paid, and they would be now able to at least think about planning, and they would get a good tax planner for themselves, tax advisors. So thank you very much for this conversation. It was very great having you here.
Thank you so much, Sushil. Finally, we made it. I know you made this work, and I was really here and there around and not being able to make this happen, make this work. But you very kindly chased, you very kindly managed it, and finally we're here and we are done. Thank you so much.